Hello and welcome everyone. My name is Cameron May. I'm a senior manager here at Schwab, and this is Advanced Charting Techniques. And guys, we've all heard the phrase, follow the money. Sounds like a good idea, but what might a trader do in order to try to implement that piece of advice? Well, today we're going to be talking about and trading an index on a chart, an indicator on a chart known as the money flow index. It should be a really good discussion. It's an indicator that attempts to combine price movement with a volume confirmation to see, well, where does money seem to be flowing, at least on one stock. So it should be a great discussion. Before we can get into the particulars of the indicator, how it's built, how it might be used, let me first of all say hello to everybody out there. Great to see all my YouTube friends. Hello there, Paul and Ray, Melvin, Will, Bob, Chris B, Kevin, Ocean Life, Life in the Fast Lane, Michael, Frankie, Selva, everybody else. Thanks for joining us week after week. I really do appreciate your attendance and your contributions in these discussions. I already see somebody saying, hey, I'm here for the very first time. Well, welcome to you. Welcome to anybody that might be here for the very first time. I really appreciate you taking your time out of your schedule to join us today. And if you're watching on the YouTube archive after the fact, if you're just watching the recording of this presentation, enjoy the show, but be aware that you're invited to join us in a live discussion. This is a Friday webcast series, and we kick things off promptly at 1 o'clock Eastern time. We would really love to have you here in the live stream audience. I also want to let everybody know, special guest out there in the chats, one of my very good friends, a peer of mine, Ben Watson, is going to be assisting with any questions that I can't get to. As long as those questions are on topic, Ben's there to pick up the slack if I can't get there. All right, so thanks, Ben, for helping out. Definitely appreciate you. But Ben and I would also like to issue an invitation to everybody, whether you're watching live or you're watching on the archive, make sure that you're following your favorite instructors on X. That's the best place to connect with your favorite instructors, and it's the best place for us to communicate developing ideas, developing information in between the live streams. So you can find Ben there at Ben Watson CS. You can find me there at Cameron May CS. But with that, let's get into the money flow index. And as we do, of course, we need to consider the risks associated with any approach to investing. These disclosures are important, so bear them in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. Any investment decision you make in your self-directed account is solely your responsibility, and all investing involves risks, including the risk of loss. All right, so let's set an agenda for the day. What do we want to accomplish with our time together? Well, we're talking about an indicator that's likely going to be new to a lot of you. So yes, we're going to dedicate the bulk of our discussion to that. But first, I want to take a quick peek. I already see Chris B chatting in about last week's discussion. We placed a trade last week. Let's do a quick follow-up, see how it's coming along. And then we're going to take a look at the S&P 500 and frame it within our trend, value, and momentum grouping of indicators to see how that's performing. And then we're going to get to the real meat of the discussion, which is an introduction to the money flow index and how it might be used to, quote unquote, follow the money. All right, so it should be great. Let's go right to the thinkorswim desktop software platform. And I'm going to start here on our monitor tab. Here's our position from last week. We bought 5 shares of Costco, $920. Let's go see what that's up to. You can see we took the position. Actually, was this last week's trade? I thought it was. Let me quickly click on this. Costco was 2 weeks ago. All right, well, let's go to TDG. There we go. Let's bring up TDG. Costco, you can see, we entered a couple of weeks ago. Stop down here. Target was up there. Making our way. That's great. We'll see if we can get there. TDG. So here's TransDime. What we noted in last week's discussion is we had a combination of technical factors, including a technical range that had just been broken out from. So we entered on the strength of that. Looks like we teased right up close to our target. So a trader paying close attention to this may have decided to get out that close. We have it automated. The automated trigger was not hit. So now we've sagged back a bit. So trade's doing okay. We'll see if it continues to perform. Yeah, Janelle, I see you say, Ben, hey, Ben. Yep. Great to have Ben there. Ben's a great presenter. You know he is, and he brings a lot to these discussions, so great resource to have there to help out. Okay, there are our positions. Let's go have a look at the S&P 500. So here's the S&P. We can look at a plain chart, but I'm going to bring up each week that trend, value, momentum grouping of indicators that we discussed. If you missed that discussion, let me do this. For the live audience, I'm going to copy the link and paste it out there. There we go. So there's the link to that discussion where we went through this set of indicators. Let me load up that set of studies. Load our study set. I call it the TVM strategy set, which is trend, value, and momentum. Trend on the S&P as defined by a pair of triangular moving averages, the 50 versus the 100. We have the 50 above the 100, indicating possible continued strength in the trend of the S&P. We see our RSI dipping down below and adjusted up to 40. This is interesting, might tie into today's discussion. Yeah, we adjusted this up to 40. We dipped down just below 40, which might to some indicate short-term value in a stock, price coming down to possible levels of support. And finally, MACD shifting from light red to dark red may indicate that the stock is possibly set to resume its momentum in the direction of the established trend. But in any case, in this case, we're applying it all to the index, the S&P 500. And you can see since that confluence of technical factors, which they seem to come together right about January 14th, we've really blasted off from there. It's not obviously a function of this group of factors. Lots of things at play that can determine which way an index goes. But for some, this might have been an indication that it was about to turn. And that's what it turned out to do. So nice to see. We'll keep an eye on these. It looks like we might be getting up there a little bit on our RSI. Our MACD is getting a little bit higher. For some, that might signal, is it time to be adding on to new bullish stock positions? If we're looking through this technical lens at least, I don't know, might be getting a little bit long in the tooth. Time will tell. But we're going to go ahead with the rest of our discussion. And I do want to talk about this indicator known as the money flow index. Now, how many of you have used the money flow index? And I want to be very specific here. The money flow index is different from, very different from, the indicator also known as money flow. You have MFI and then just money flow. Those are different things. So let me load up our money flow index on a different chart. Let me remove all these extra indicators. There we go. Nice clean chart. Let's flip over to our first example, security. And I'm going to add our indicator here. Let me just come up to the edit studies icon. We can go down in alphabetical order, or we can just start typing in the keyword money. There's money flow, which we are not discussing today. The money flow, very much like if you're familiar with on-balance volume, it's essentially an identical indicator, just with a slightly different interpretation. But let's go with the money flow index. Jay Richardson, you've never heard of this one before? Well, I think this is going to be a fun discussion. I had a little internal back and forth with myself as I was preparing for this webcast, because sometimes I'll sort of skim over the particulars of how an index or an indicator is constructed. Other times I say, let's get into it. Let's get deep in the weeds and really explain how this thing works. And today I was wrestling with myself because this is a little bit more complicated. So I was tempted to say, well, let's just sort of brush through it. And then I thought, no, this is my advanced technical analysis crew. They're up for it. Let's talk about how this thing is built, and then we're going to talk about how it's used. So I just want to say that to set the stage that for some people, they don't really care how the thing is built. They just want to know how it's used. So this next 10 minutes or so, for some of you, maybe it goes over some heads. Maybe it's not a topic of keen interest, but I really kind of struggled also to find another video out there on YouTube that really explained this well. So I thought, I'm going to write it up best I can, make it as short as I can, and talk about how it's actually built. So let's open up our Scratchpad. And I've sort of summarized this, the construction of our money flow index, into 4 steps. How is this thing built? But before we get into the particulars, let me just show you the basic appearance of it. You'll notice, just like that RSI that I just mentioned, looks almost exactly like an RSI. You're going to see it moves differently if you were to bring up RSI and money flow index on the same chart. But basically, you see an 80 line, a 20 line. Yes, those are overbought and oversold ranges. And then you see a black oscillating line going up and down between overbought and oversold. You'll also notice that it's range bound. It can't go above 100. It can't go below 0. So those are the basic elements of our money flow index. But how do we come up with this number? Right now, the money flow index is almost exactly 45. Well, there are 3 steps. You ready for it, Janelle? Step number 1 is we've got to, if we're trying to follow the money, well, what we might be talking about is what is the price of something doing? If price is going up, maybe there's inflow of money into that stock, causing the price to go up. However, if the price is going up without a lot of inflow, which is still possible, you can have just a little bit of buying, a little bit less selling, and price still goes up because the balance tilts towards the buyers, even though there's not really any flow of money. So yeah, this is going to have an element of price, but also a strong element of volume. So let's talk about price first. So we could just look at the price chart and see, well, are we going up from one day to the next? That's fine. Close to close is what a line chart accomplishes, but the money flow index actually looks at what's called the typical price. What is the typical price? It's not just the closing price, but closing price is a part of it. Your typical price is just the high price plus the low price plus the close price divided by 3. So it's sort of taking an average, okay? So we have to calculate a typical price for a given day. And then we just look to see, well, did that price go up from yesterday's typical price, or did it go down from yesterday's typical price? You might think of it, if it's helpful, I think it'd be just as fine to say average price, okay? High plus low plus close divided by 3 to me sounds an awful lot like calculating essentially an average price as well. Did I get an extra space in there? Let me get rid of this extra space there. There we go. So that is not terribly heavy lifting, and hopefully I've broken this down enough so that everybody can follow. Step number 2 is to bring in that volume element. So is the typical price or average price going up or down day to day? And also, is it supported by volume? So this next element, we calculate something called the raw money flow. And it's basically price times volume. So we take our typical price and multiply it by the volume. So if our typical price for yesterday was $50, or for today is $50, and we had 1,000 shares traded, that would give us a raw money flow value of 50,000. However, that money flow value can either be positive or negative, depending on whether the typical price went up or down from yesterday. So just remember that when calculating this, we look to see, did the typical price go up? In that case, we multiply it by today's volume, and our raw money flow value is positive. If the typical price went down from yesterday, we multiply it by volume, and it's a negative value. All right, we're already on to step 3 of 4. Now, I wrote out some equations here, so you're going to see me looking back and forth, because I want to be as brief with this as possible. Now we need to calculate something called the money flow ratio. So we're going to calculate this raw money flow value, this price times volume value, every day for 14 days. And then we're going to look at all the positive values and add those up. We're going to look at all the negative values and add those up. So we're going to take our 14 period positive money flow and divide that by our 14 period negative money flow. All right, that's step number 3. And I'm going to go through an example here, just so we can outline this theoretically, but then also put it into some practice. Now, the final step, once we've calculated this ratio, is we just throw it into an algorithm. And here's the algorithm to calculate the money flow index. also known as MFI. I didn't abbreviate the index because we already know what the MF stands for, money flow. Our money flow index is calculated by taking the number 100 and subtracting from that 1 plus our money flow ratio. There we go. Oh, pardon me. Yeah, yep, no, I got it. That's exactly right. Okay. So, oh no, it's not exactly right. I knew I was missing something. There we go. It's 100 minus 100 divided by 1 plus the money flow ratio. All right. So that's the steps for calculating this value over here. Let's run through an example. All right. So our example, let's say that we looked at today's high, and it was $11. The low was $9. And the close was $10. Tell me, what would be our typical price? Well, typical price is high plus low plus close divided by 3. So 11 plus 9 plus 10 is 30, divided by 3 is going to give us a typical price for the day of 10, or you might just think of it again as an average price, not exactly the same, but close enough for the logic of this. Typical price of 10, we have accomplished step number 1. Now let's suppose on the day, volume was, let's just say it's a really thinly traded stock. It also keeps our math really simple. Let's say we had 100 shares traded. So, next step, tell me my raw money flow value. Raw money flow is what? We take our typical price, 10 bucks, multiply it by the volume, 100 shares. Sometimes it's going to be positive, sometimes it's going to be negative. So we know we have a value of 1,000 here, but was it positive or negative? Well, we have to know, was this typical price higher or lower than the previous day? Let's say that it was higher than yesterday. Let's say yesterday's value was $9. Okay, so we went up in our typical price from day to day. So our RMF is now 1,000. Now we simply look over the last 14 days, and we look for all the positive RMFs, we add those up. We look for all the negative RMFs and add those up. And we just divide the positive by the negative. So let's say that we have our money flow ratio. Let's say we had, out of the last 14 days, 8 days, very similar, generated an RMF of 1,000. So we add those up. That gives us a positive 8,000. Okay? And then on the negative days, there are 6 days. Let's say they were also about the same value per day, 6,000. Now, we're just going to divide this. Don't divide by negative 6,000. It's just 6,000. So it's the positive value divided by the negative value, but both just essentially expressed as positive numbers for this. All right, so what ratio would that give us? 1.33. And now we're ready to just plug it in. Okay, Roy says, how will this ever be negative? So this is never a negative value. It ranges only from 0 to 100. You'll never actually see negative numbers used in the equations here. All right, now finally, yep, Speak Truth says, Cam, for your information, money flow index is 100. Am I missing something here? It's 100 minus, not 100 divided by. Okay, anyway, so let's plug this in. I'm going to, just to do this simply, I'm going to copy this. And let's paste it right down here and see if we can plug this in. Okay, so what's our money flow ratio? It's 1.33. What's 1 plus 1.33? That's 2.33. What's 100 divided by 2.33? Let's figure it out. 100 divided by 2.33 is going to be about 43. Forgive me, I'm going to round. We're going to call this 43. And then what is 100 minus 43, giving us our final value of 57. That's it. So that is the equation right up here. And now you understand the process. So all of that to say, what are we trying to accomplish here? Well, we're trying to define maybe a quote unquote a truer movement in price, not just close to close, but taking in sort of an average price from day to day and seeing if that average price is going up or down. And then we're trying to see, is it being supported by volume? And if we're getting more and heavier volume days on the selling days, it's going to drive our money flow index lower. If that starts to be replaced by more and stronger buying days, we'll see our money flow index rise. And so are we now following the money? That's the concept. Is it? Chris B says, wait, did you say on down days something is calculated as negative? Well, a better way to put this, Chris, because this is the equation. We call it negative money flow. But it might be easier to say the 14 period up money flow, 14 period down money flow. We just add up our totals here, divide the up by the down. It's not necessarily in math, we want to throw a minus sign in front of anything that's negative, right? In this case, the divisor is never negative. It's just a positive number, even though it's a down day. So let me get rid of the plus sign so it's not confusing people, making us think that we might need a negative. In any case, this equation spits out this value, which changes depending on the price movement, also needs to be supported by strong volume. Higher prices with stronger volume is going to drive our money flow indicator higher. Lower prices with lower volume is going to drive our money flow indicator lower. That's it. All right. Are you saying I need extra parentheses around something? Oh, you're saying like this. I get you. Yeah, I know. It's been a while. Forgive me. I'm a market instructor, not a math professor. Anyway, I do think, though, that's done about as thorough a job as any video that I've seen. I couldn't find one that did this. Matter of fact, it did a very good job of it. Anyway, so there's the equation. Here's the outcome. So what does this do for the trader? Well, if they're attempting to follow money, are we generally looking to see when prices, are we looking to conceptually get in when price has already been supported by volume and driven it up to short-term highs? Or is the trader maybe looking to see if the flow of money has driven prices lower, possibly to extremes, and then is just starting to strengthen? Yeah, welcome to Algebra 1. Paul, thank you. I thought I'd put that behind me. About, how long has that been? 40 years ago? Yeah. Anyway, but money flow index traders are basically looking for the money flow index value to be dropping and dropping, conceptually here, meaning that there may be a net outflow of money. Even at times when price is not really going much of anywhere, if our indicator is going down, it might indicate that, that on the selling days we have stronger selling than we have strength on buying, and that can push down to extremes. The closer we get down here to zero, the more unusual that circumstance is. You'll notice we don't get down there very often. So when we reach these extremes, for some traders that can be significant, especially if we start to recover from those extremes. So one signal that a trader might look for here from our indicator is a dip down below 20. We have a very high concentration of selling volume versus buying volume that may have pushed us out to the outer envelope of price activity in the short term. And if we can just get that reversed, the trader might see that as catching things at a potential low when the flow of money is starting to reverse higher. So the beginnings of a potential signal are when we're below this 20 line known as the oversold area. The implication here being that prices and volumes have gone to such an extreme that they've reached a scenario that's just not very common. and it may be likely that we're going to reverse course from here. And how do we define the reversing of the course? Well, if we get back up above that 20. Now, Speak Truth says that, no, I appreciate your approach. Hope you weren't too persnickety. No, I appreciate it. I actually, if you'll notice, I'll take time out to make sure that I'm grammatically correct on things. And so if you correct me on where my parentheses need to be, that's great. All right, so that is a possible signal to a trader. Look out, there is a shift in the flow of money here. Maybe price is about to rally. I have to qualify that with a maybe because nothing is perfect in technical analysis. This is not a guarantee that price is going to go up from here. But the assumption for the trader of the MFI is that it's likely to. And so they may take that as a signal. Now, for some, that's actually a perfectly adequate signal all unto itself. And they may just trade from these lows and possibly shoot for highs. For others, though, they combine with other indicators. So we're going to be doing that. Pinpoy says, could you run a scan for MFI? I think you can. I didn't just confirm that before the webcast started. Maybe you can play around with that afterward. I'm not going to be doing that today, but it's a good question. I did want to say, though, before we move on to tying in a second indicator, there is a survey out there in the chat window for those that are here in the live audience, and I always appreciate it if you take the time to fill out the surveys. They're really short. They're super short. Two multiple choice questions, a comments box and a suggestion box. But if you take the time to fill out our surveys, I always take the time to read through that data. I read through your comments. Sometimes I build whole webcasts around the suggestions that are made there. It's always helpful, okay? Chris says, any of those low points in the uptrend may be good entry signals for continuation trades. Also accurate, yeah. Does it always have to be a short-term trade, even though we might be using a somewhat short-term indicator? I say somewhat because this one actually doesn't signal very often. So for some, they may see this signal as particular importance, as carrying particular importance, and it may lead to a trade that lasts for a while. Harlot 3000 says, will this work for a 5-minute chart? Well, Harlot, just like with so many of the technical techniques that I teach in this webcast and another series that I've done, yeah, the concepts are portable from one time frame to the next. The vast majority of these concepts can just be moved right to a shorter term time frame or right to a longer term time frame. But that said, work is a strong word because if I say this will work, that might imply that the next trade we place, even on a shorter term time frame, is going to work, or a longer term time frame is going to work. It may work or it may not. Some of these are going to work great. Other times it doesn't work, so we have to have a plan for things that fall apart. But yeah, the application concept is basically the same on a shorter term time frame. So here's an entry here. We just have a recent signal on BlackRock right here. Okay. So if we're not taking the signal in isolation just from the indicator and trading the indicator exclusively, what else might it be paired with, hopefully to improve the signal? Well, for some, they see this as an oscillator, which is sort of a shorter term momentum or value indicator, and they might pair it up with trend, just like we did earlier in this webcast where I used a couple of triangular moving averages. Let's use a trend indicator. And as I do this, I'll say that this is one that doesn't signal very often. And so if we pair it up with a really fast moving average, it doesn't work very well. Moving average is giving all kinds of buy and sell signals, all kinds of support and resistance levels, and our indicator is just waiting. It's not doing anything. So we're going to slow down the typical indicator used here. Let's come up here. Let's add a slower, simple moving average. Could use an exponential. It's not going to make a huge difference. I'll use a simple because it tends to be a little bit slower even than an exponential. And I'm going to slow that down from the default 9 days. Let's crank that all the way out to 200 days, not 2,000. 200 days, this is taking an entire year's worth of data to generate this indicator as a potential trend indication, but also as support and resistance. So typically, said Croft says, how would you back test this? Well, you can just load up these indicators and just run through how long would it take to go through a series of charts. If I were to come over here to the S&P 500, let's just pop up here to the top and just click through and look for signals. And what are the signals we're looking for? Well, the trader's typically looking for price to be above an upward sloping trend line, with a preference probably to be close to that trend line, and then confirmed by a dip below 20 and then a rise back up above 20, right? So we could just scroll through here and look for those sorts of things. Here's an uptrend. When did we last? Oh, actually, there's Apple. Oh, I'll make a mental note of that. I didn't even notice Apple. I'm going to come back to that. Apple, that might be our trade today. Anyway, yeah, we're trading right close to our moving average. We just dipped below 20, and on we go. Look at Microsoft has been so choppy recently. Our moving average has kind of been intruding on the lower portion of these swings. But just recently, we got below 20, and let's zoom in here. Here we're below 20, but still below the moving average. So the trader might wait a couple of days to get back above the moving average before they take entry. Paul says, where does a 100 or 50 SMA come into play? That's a terrific question. Isaiah, you just asked a question it's almost identical to one that was just asked a little bit earlier. That's okay, you might have missed it. Somebody asked about a 5-minute chart, 1-minute chart, 3-hour chart, weekly chart. Can this be used on different time frames? It can. Will it be perfectly profitable every time? Nope. It's not going to be perfectly profitable every time, no matter the time frame. So let's go to the question. Let's see, who asked about, it was Paul. Where does the 100 or 50 SMA fall? Well, for some traders, this can be a combination of signals that just doesn't happen very often. So even as we're looking, let's look at Microsoft, just since we're here. This is where we landed. We've had one signal, exactly one, all year long on a stock that's been pretty persistently uptrending. So a trader waiting for the signal could have been waiting for months and months and months and months and watching all of this happen. Hey, Cameron, I'm missing out. Can I speed this thing up? Yep. So let's go to another symbol here. Let's go to Costco. I guess Microsoft might have been a perfectly good example. But sometimes a trader wants to speed things up a bit. And just like with RSI, we're going to make an adjustment here. So with RSI, we have an overbought and oversold. But what we'll notice is quite commonly, in a really persistent trend, our oversold just never happens because there's so much buying enthusiasm for the stock that keeps it suspended at higher levels, pushing higher and higher, so persistently that there's not really a time for the sellers to get enough control for a long enough period to even drive it down into that oversold range. So maybe we need to nudge that oversold range up a bit, especially if markets and stocks are really strong. So here's an adjustment that's commonly made. We're going to go back up to our study. Let's change our money flow index. Click on the little gear icon here. And instead of having the oversold be if we dip down below 20, it might be 30 or 40. RSI, a typical adjustment in a bullish trend is about 40. Let's set this to 30 for now. All right. So we've sped up the indicator, we've sped up the money flow index. Maybe we want to speed up the moving average as well. So I'm going to come up here to our 200. Let's cut that in half. Instead of looking at a year's worth of data, let's look at the last 6 months, the 100 trading days. That's about 6 months, a little bit less. I'm going to click OK and click Apply. And now the trader might get a few more signals. Now notice this went from 1 signal this year to 2. All right, is that a ton? No. Money flow is not designed to whip back and forth and generate tons of signals. Obviously, if we shorten the time frame, it's going to generate more signals. Use it on a faster moving chart. But on this daily chart, this isn't uncommon to only have 2, 3, 4 signals in an entire 12-month period. But again, if we wanted to backtest this, we could look to see, are we trading above or near our moving average? And did we dip down below our money flow index oversold and then pop back out of it? In this case, yes, that would have signaled right about here, which turns out to be a couple of days early. Notice the price still went down a little bit further. So this emphasizes the danger of getting in with a very tight stop here. It's a technical indicator that's intended to try to refine the precision of getting in at lows, just as the flow of money is potentially shifting, but it doesn't get it exactly right every time, or even most of the time. So where might the trader, if they're planning for a trade that truly breaks down and falls apart, where might they plan their exit? Well, if they're getting in above the moving average as we're rising out of oversold, if we fall below that moving average, it may put that trend in question, and it might be time to pull the plug on the trade. So maybe a percentage point or two below the moving average as an exit. And right here's another example where we dip down below. Here we're solidly above the moving average. We actually got a signal here, but then it came down further, and you can see how it came down and really teased with that moving average. Didn't get much below it. A tight stop there would have been stopped out. Now this is a trade. This is a position we already have a trade on. Interestingly, generating a signal pretty close to the entry point of our last trade, of our other example trade. It's just that this one would have come a few days later. This one happens less frequently, and a confirmation typically takes a little bit more time to truly confirm, hopefully in an exchange of the speed of the signal for quality of the signal. Not always the case, but that's the intent here. All right, so there's our potential entry signal. What should we do? I think we are starting to really understand how this is built. We understand how it might be combined with a trend indicator to build a system of trading. We know where the trader might position to hopefully minimize losses. Now, if we have a stop down there, just like with any stop, it's not a guarantee that we'll sell it at a specific price, but the trader's still drawing that line in the sand. But where might we take our profits? Well, a couple of ways that might be done. Let's go back here to Apple. Was it Apple that had was that the one? Hold on a second. Let me go to our watch list, the S&P. I swear we had something that had just come down. Was it our 200-period moving average in combination? Yeah, it was, wasn't it? Yep. Let's switch this back up. Let's go back to our 200 signal. Click OK. Let's put this back to the default 20 oversold. Click OK. Click Apply. So there's our signal. Pretty fresh signal in today's market. That's pretty uncommon. There are the way the S&P and the other major indices have been behaving, most stocks are going to be closer to the overbought zone than to the oversold zone. So it might require some scanning down through here to find something with a recent signal. You see how many of these are up here rather than down here? But yeah, Apple just touched off that 200. There is this right around the corner for anybody that gets nervous about earnings announcements. We'll see. We do know with Apple, more than 50% of their revenue is still generated by their phone sales. Is it going to be strong enough? I don't know. That's a fundamental outlook. Technically, the signals are lining up. Should we do a trade here? Let's plan a trade. Let's buy now. Let's place a stop below our moving average, which is at 218. A couple of percentage points below that is going to be down around 214. So let's just have a stop down there. Where might the trader take their profits? Well, one way is to look to see if we get back up above the overbought territory. If we slip back down below, they may exit on that sort of a signal, or they may just use the chart and look for previous price ceilings. I see one here that's been a resistance point on a number of occasions, or we could also see if we can get up to that resistance up there. Both of those would be in keeping with typical trade planning using this indicator. Let's see. Chris B says Apple broke above the MFI 20 in the last 3 days. Yeah, it's the only one on the S&P 500. Okay, interesting. So let's go ahead with a trade here. Placing our stop at 214. Let's put in our target up here. Let's see if we can get 260. Let's go to our trade tab. Let's buy some shares of Apple. I'm going to right-click on our ask price here. put in a custom buy order with an OCO bracket that allows us to put in an order to buy shares and to sell those shares. Now, this is a $222 stock. 10 shares would be $2,200. We've been spending about $5,000 on each trade. Let's do 25 shares. That'll be a little bit more than $5,000. Let's link those together. There we go. And I'm going to put this in as a market order. The markets are currently open. Stock's trading around 222. Market order is not a guarantee that we'll buy at exactly whatever price we're seeing on our screen. Let's put in our limit. That's our target price up at 260. Let's put our stop down there at 214. That's down below our moving average. And make these both good till canceled. Now we're going to click confirm and send. Buying 25 shares of Apple, it is going to be about $5,500. And there's no commissions on this trade, but there can be on some types of trades. We're going to sell those if we can get to 260. Or we're going to sell if we fall down to 240. That's our trigger, and then we get what we get at that point. So with market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. So we're not guaranteed that we're going to get this stock for $222.32. With stop orders, there's no guarantee that the execution price, the price that we ultimately receive if our stop is triggered, that the execution price will be equal to or near the activation price. Our activation price here would be 214. Let's send that order off and see if we get a fill. Should. That's a market order. Should fill quickly. There it is. So we're in at 222.33. So we'll see where Apple goes from here. But guys, we've accomplished what we set out to do today. I wanted to provide an introduction to and some trading of this indicator known as the money flow index. It's an attempt by a trader to use the charts to address this piece of advice here to follow the money. It provides a definition for that and a possible way to trade it. So I think it's a great discussion we've had. We went through our existing position. We looked at market conditions. We talked about how the MFI is built in good detail, and then we traded it. So Mighty Mouse says, are we concerned about earnings next week? Yep, we talked about that, Mighty Mouse. It is a concern for some traders. For others, they're okay. If you think about over the course of a career, if we do thousands of trades, and a lot of those go over earnings, some of those earnings are going to go well, some are going to go not so well. It could turn out that earnings is a non-event over a full career of trading. Maybe it compounds into something significant or maybe not. So yeah, on an individual trade, some traders just don't like trading over earnings. That's always up to trader preference. All right. But everybody, time for me to let you go. But as I do, just remember we have other educational resources available to you outside of these webcasts. For example, make sure that you're subscribed to our Trader Talks channel. It doesn't cost anything. You can go down and click on the subscribe button right now. It only takes a second. But our channel is where we house, yes, our live streams like this one, but also the recordings of all of our previous discussions, our previous videos are right here under the playlists. So you can find those. Some aren't archived, a very few, vast majority are archived right here. So make sure that you're subscribed, and also if you're not following Ben and me on X, please do that. It's another resource for you. Best place to connect with your favorite presenters when they're not in a live stream is on X. So you can follow Ben there at Ben Watson CS. You can follow me there at Cameron May CS. That doesn't cost anything either. So if you have an X account, go give us a follow today. We definitely appreciate it. But everybody, thanks for giving me the thumbs up or the like. I can see over 200 people watching, and we've had 65 already that have given a thumbs up. I appreciate that. That's like a pat on the back to your presenter. It also helps the presenter's video get a boost in the YouTube algorithm, helps us find a wider audience and help more people. So that's a win-win. So thanks for doing it. Always make a habit of just clicking on that like button before you sign off, if you like the webcast. All right, everybody, I will see you next week. Go enjoy your weekend. I'll see you in a future webcast. I'll also look for you on X. Thanks, Ben, for helping out in chats. This is the last time to fill out the last reminder just to fill out that survey. That would be very much appreciated. But I'll see you some other time. And until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.